Well, welcome to another weekly S&P 500 ChartStorm run-through. What this is a YouTube video run-through of the various charts and comments that I put on the weekly ChartStorm that I do over on Twitter. So we'll get this straight into it and over on to number one. The first chart here shows the number or the percentage of 52-week new lows. It's one part of the new highs minus new lows indicator, and really the reason why I decided to feature this one is because if you look at this, there's sort of seems to be, a little bit of an uptrend here, and this kind of indicator really only makes major moves when you have a correction of sorts, such as this period here. And that way, and in that fashion, it can be a bit of a contrarian buying kind of indicator when it really does spike up like that. But otherwise, if you're getting higher highs and the market's continuing to go up, and you're seeing more and more of the new lows starting to appear, it can be something that you would like to have on your risk radar. And on to the second one. So this is the S&P 500 in the blue, and in the white line there, that is the S&P 500 high beta index. So this is an index of stocks that are generally more volatile than the index itself. They tend to move higher when the market's going up and lower when the market's going down. And the point of this chart here is that you've seen the high beta index roll over. And more to the point, I guess you've seen it roll over at the same time as the S&P 500 itself is going up, which can be a little bit of a divergence kind of indicator. So another one to be aware of, and another one to be aware of if you haven't heard that index before. So number three is the trade followers bullish versus bearish tweet activity, and they end up with a Twitter breadth indicator, which is quite an unusual indicator, and I always try to find and bring you some unusual indicators. And probably, I guess, the reason why I decided to actually feature it this time was that, as you can see there, the green line, which is the number of bullish stocks, or stocks where there's a lot of bullish tweets going on, it started to roll over. We've seen that happen a couple of times in the lead up to sort of a period of consolidation. So, in that case, with a slight roll down there and a period of consolidation, quite a small correction there, or sell-off, if you could even call it that, in that instance. And then we also saw it heading into the more meaningful kind of corrections back at the latter part of 2015 and early part of 2016. So you could see into January there's a slight downward slope there, and then you had the sell-off where it went all the way down and ended up giving a bit of a contrarian signal when it became too bearish, or too few bulls and too many bears. So it's an interesting one to be aware of as well. Number four, insider transactions. So really what I'm just commenting about there is that insider sales is starting to pick up. Purchases are up slightly a little bit as well. But it's another one to be following. At the moment, it's not really at extremes. So, it's not really presenting a warning as such, but just a little bit of extra background information. Number five is speculative longs, or net long futures positioning in the E-mini S&P 500 futures by large speculators. Now this one, it's sort of, looking at the chart, there's not really a consistent signal that it sends. I mean, if anything, it just gives you an extra lens on the kind of sentiment that's running the markets. And if anything, it looks a little bit like a momentum indicator. Here you had a bit of divergence between prices and the sort of increasing negative or short positioning there. But then, you had the same thing happening here without a subsequent actual, meaningful correction opening up. And, but there has been times where it's offered a reasonably reasonable contrarian indicator, like, at this point here in July last year, where it got quite carried away. Very, very net long, very extreme positioning there. And there was a little bit of a shakeout just into the election, sort of very brief one-off shock. And by the same token, when we were at the market bottoms in the twin corrections there, it got to extreme short positionings towards the bottom, which, I guess even from a flows point of view, if you think about these positionings as potential buying or potential selling, when it's very stretched to the downside, it means that those people that are holding those net shorts are going to be potentially squeezed at some point, and it can result in quite a meaningful snapback. Now, speaking of sentiment, here's one of my own, and this one I call the Euphoria Meter. Now, this indicator is made up of three components: the forward PE ratio, the bullish sentiment readings from the Investors Intelligence Survey and the AAII survey, and then the VIX. So those last two ones are smoothed on a 12-month basis so that you can see more of the cycle. If you don't smooth it, they can become very noisy. But the forward PE is just exactly the month-to-month readings. So the interesting part about this one, or the reason why I've decided to include it this week, is that you can hardly see it there, but I've checked the data and it has actually moved to a post-crisis high, so the highest point that it has been since the early 2000s. Now, that's not in and of itself a reason to, necessarily be fearful, but the old quote of "be fearful when others are greedy and be greedy when others are fearful." I guess that this does represent a certain element of greed starting to work its way into the market. Leading into the dot-com peak there, it did actually get a bit higher than where it is right now, and at that point it was driven by valuation. At the moment it's driven by a very low VIX, by increasingly high valuations, and now quite a little bit more usually, but more lately rather, is the bullish sentiment starting to really kick in after quite a wash-up moment there, really, into in the early part of 2016. As a matter of fact, it worked as quite a decent, it gave pretty decent contrarian buy signal at the market bottom then. So, it served its purpose on the bottom side. So now time will tell whether it'll serve its purpose on the top side. Chart number 7 is this Sellside Consensus indicator from Bank of America Merrill Lynch, and that was shared by Jack Dam's Twitter account there. So make sure you go and check out what interesting charts and comments he's sharing, because he's always got some good things there. And really what this is showing is, it's moved from a position of quite extreme bearishness to, well, I guess you'd call that neutral levels, wouldn't you? Certainly not euphoric as it was around there, but, if it keeps on heading in this direction, well, we'll see. And speaking of consensus or forecasts, this chart here in the grey bars, which you can sort of just see, has got another quarter of growth on the cards for Q2, but just a little bit less than the Q1. So there's probably an element of base effects starting to wash out there. If you look at Q1 there, it's very low, Q1 there very high, and then Q2 there was less low, and Q2 is going to be less high, and that's probably something to be increasingly conscious of as we progress through the year, because a lot of the really strong data, really strong signals that we've seen earlier this year on earnings, on profit growth, industrial production growth rather, inflation, etc. I mean, these have all really sort of been, any growth rate is going to be receiving a boost from the whole base effects, just the fact that, when you put a year-on-year figure on a low previous figure and normalize the one that you're looking at, it can give you, a more accentuated signal than it otherwise would. I think it's still in the right direction, but, it's easy to get wrong-footed if you forget about that effect. And number 9, you have here the price to sales ratio from Alex Pitty, another good account to follow there. And the price to sales ratio. So on first glance, it looks, potentially is something that would be concerning. It looks like the market's extremely overvalued. If you look at the latest parallel of the dot-com boom era, it would kind of give you, potentially, of course, get worried. But of course, as I mentioned there, $1 of sales today is very different from $1 back then. And the composition of the S&P 500 is actually quite different as well, which we'll talk about in the next one. But the point about $1 of sales being different today, well, there's a couple of factors that are direct and indirect. So the first one is the profit margin. Profit margins are generally quite a bit higher today, so a lot more of that sales actually goes through to earnings, which is what ultimately matters. And then the other thing is, if you think about interest rates, so the discount rate is actually materially lower than what it was back then. Now, you might argue that the terminal growth rate is also lower, as a whole, because, bond yields generally will go down as nominal growth outcomes go down. So you could argue that that is, at least a partially offsetting factor. But even if you set that aside, you just think about how low interest rates are, it certainly provides some justification that valuations should be higher. So those are two conditions that aren't captured in this chart that you need to be aware of if you are going to be going and running around and making big conclusions off a single chart. And then the last one, I mentioned S&P 500 sectors, so sector market cap representation. And no surprise, perhaps, to most, that info technology is at the top. Actually wrote a bit about this elsewhere, why that's really not comparable to that period there. I might put a link to that. Well, actually, I do put a link in that article there. So if you want to read more about that chart itself and a bit more about what's going on in IT, just click through to that link there in the actual in the tweet. Otherwise, I guess what's also interesting there, the opposite of tech, energy going down, 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 and no prizes for guessing what's driving that. But probably another interesting thing there, and it's something that I also wrote about actually in that article there, is a sort of a little bit of inequality. It's not the type of inequality that we're usually talking about, but you look across there, it's many different stories going on. There's a few at the bottom that once had significantly greater weight, and then there's a couple at the top which are becoming what look like increasingly dominant parts of the index. And that's always something to keep an eye on, or at least be conscious about when, in this day and age, even if you are an active investor, you're probably investing with a benchmark, or if you're investing in an active fund, it's probably got a benchmark, or at least some awareness of what the actual benchmark is. And if you're passive, then of course this is what you're getting, right? So it's something that you that's definitely worth keeping in mind. All right, and I will leave it at there. So that was our second my second weekly S&P 500 ChartStorm walkthrough. I'm still sort of trialing this out to see what kind of response I get, because I just thought it would be a good way of putting a bit of extra context and explanation. So do chuck your comments or questions, or your debates, your arguments against anything that I've said, into the comment section of the YouTube video below, and be sure to subscribe to the channel. Be putting another video out later in the week talking about a topic from the weekly report service that I do for my business.